Moving average trading strategies have been applied for decades by traders of all levels, successful and even those starting out. My name's Ashley Jessen from LearnCFDs.com, and today what we're going to take a look at is applying and using a certain number of moving average trading strategies. So we're going to run through a handful of trading strategies, 5 of them in total, just to have a look how moving averages can be applied to your Forex trading strategies. Now, as you can see, I've got MT4 open currently with the euro dollar. It's just the middle of August at the moment. It's had quite a run as the US dollar weakness has really continued over the last couple of months. So as you can see on the chart at the moment, I've got a stochastics down the bottom, and I've also got a 100 period moving average. Now, this is at its very simple form. A lot of people like to use a long-term moving average as a trend direction filter. A lot of people use a 200 period moving average. That's fine. Just to note as well, the moving average, this is a simple moving average, and it's calculated based on the number of periods. Now, I'm actually on a daily, so this is a 100 period moving average. If I double left click on it, you'll see it's 100 period simple moving average. And if I wanted to, I could go to hourly chart, and that would be counting back 100 candles. Now, some people do ask, what's the difference between simple and exponential moving average? Should I use one or the other? I think the bottom line is you should always test. But the bottom line is whatever you use them consistently. So don't use, say, a 5 simple and a 20 period exponential moving average. But suffice to say, a simple moving average counts every day equally, whereas an exponential weighted average places more emphasis on the most recent information. Sort of like a resume. If you were employing someone and they've been in the workforce for 20 years, you would place more emphasis on their last 2 or 3 years relative to what they did, say, 15 or 20 years ago. So an exponential moving average, consider it like that resume. When you're looking for someone to employ someone and you want to look back over their history, you want to take into account their most recent history. Okay, so I want to show you how to use a 100 period moving average in a couple of different ways. Obviously, you can use this as a trend direction filter. So a lot of people would consider only trading long if the price action is above the 100 period moving average or 200 period. So 100 or 200 is usually fine. So what you'll find there is, in this case, the market, you'll see that it started to turn at this point here. You'll see it starting to rise, the 100 period moving average, and it also jumped above at that level. So that's not too bad. And what do we got? Also back here in different times. So usually all moving averages, they're lagging indicators. So they're usually a little late to the party, so to speak. Now, another way, if you want an earlier confirmation, what you might want to do, and what I do, I like to actually just look back one day. Is the 100 period moving average rising today compared to yesterday? If it's rising, I will only take long positions. If it's falling, I'll only take short positions. So as an example, let me just pop that on there. In this example here, I would never trade long in that part there. Okay, that's reversal trading at its finest. You're really going against the trend there, the most dominant long-term trend there, because this is a 100 period moving average. So in this particular case, I'd only be looking to take shorts. And if I was trading using stochastic and overbought, then I'd probably get a few false signals, maybe get stopped out. So I might be overbought here, could have got an alert to go short, got another alert there, perhaps, and another alert there. Finally got it, perhaps, but maybe a few false alerts on the way down there as it rebounded and reversed off that low down there, off that double bottom. Okay, so 100 period moving average, you can use it only trade long if the price is above it. So in this case, there was a bit of I think that looks a little bit flat there, but in any case, that might have been a false alert if you had have been waiting for just the price to close above, rather than waiting for it to turn and take signals only when the 100 period or long-term moving average is rising today compared to yesterday. Let's take a look at a second moving average crossover. So one of the most popular ways is to use a crossover. Moving averages, use them with crossovers. And in this case, what we're going to do, we're going to apply a 50 and 200 simple moving average crossover. These are more your golden cross and that type of thing, where people are looking for the long-term investor type crosses, where we're taking positions that are more long-term. They're really for actively trending markets. So I've actually got a template, and I put together a 50 and a 200 simple moving average there. So what you're looking for, you've got the 50 period short-term moving average, and we're looking for it to cross over the long-term 200 period moving average. That's the cross there. So with moving average trading systems, you tend to wait for the cross, and then once you've got the cross, there's a number of ways you can confirm it, whether you want to, as it crosses, wait for it to go above the previous high, or one tick above the previous day's high, or something along those lines, just to confirm the direction. Or you may just want to get in the next day on open if you see that cross there. So let's have a look. In this case, if you had have entered at the crossover point just there, let me put the crosshair on here. So if I had have entered, or if you had have entered there, somewhere around that vicinity there, depending on your stop loss, obviously if you kept it at the previous swing low, then you would be fine, and you'd be banking 500 or 600 pips there, which is quite nice. But as you probably already know, moving averages are notoriously slow, and they do get you chopped in and out during sideways trending markets. So it's a little trickier to see in these longer term moving average, because you don't get as many signals. But we're about to pop down to lower time frame moving average crossovers in a second. So that's the 50 and the 200. That's a very, very popular one. Next one is, we're going to have a look at 10 and 20 simple period moving average. So this is a little more active, as you can probably appreciate here. So we're looking for the short-term moving average to cross above the long-term moving average. Now, for some of you, you might want to apply that strategy I was talking about just before with the 100 period. Only ever take long signals if today's moving average, 100 period moving average, is rising compared to yesterday. Okay, so if you were to do that, we're looking for a cross there. Yep, the 100 period is confirmed. It is rising today compared to yesterday, and we've got a cross. So depending on how you enter, whether you enter on open the next day or whatever your entry criteria is there, you'll need to determine that. And as you can see, the trend evolved before it came back and crossed through. See, in this particular case, you wouldn't take a short signal on that short-term cross below the longer-term moving average there, because the 100 period moving average is still rising. You would wait for another positive cross to this side, which, as you can see, would have resulted in a handy trade there, depending on your trailing stops and how you manage your trades. But once again, when we go back to a choppy period here, and I'm going to take the 100 period moving average off, just one second, so we can see just that. So we're getting chopped in and out quite a lot here. So potentially, if you didn't have a trend direction filter like a longer term moving average, you would have got a signal to go long somewhere in this vicinity here, and you would have been bailing out down here, taking a loss, entering long somewhere in this part here, exiting just through here, bit borderline whether you would have made any money. Once again, entering long just through here, cross down, and then maybe break even or losing, and then once again the short-term crossing above. So you would take a long signal there, only to be swept out of it just a couple of days later, taking a much larger loss than some of those other ones there. So as you can see, moving averages do get you chopped in and out quite a lot during a sideways dropping market. That's one of the challenges with a simple moving average system, but they are the easiest to trade once a market is actually trending. So another popular one is the Donchian 5 and 20 period crossover. So I'm just going to apply the Donchian 520, very similar to the 10 and 20, but it's got a lower moving average, 5 period moving average on the short term one, and the medium one is a 20 period. Both simple moving averages, but once again, if you are going to use an exponential, make sure both of them are exponential. So once again, you can see the crossover through here, potentially depending on your entry strategy. You can read up on the Donchian strategy because he's got very specific entry criteria there. So you would have had an entry signal through there, and then an exit potentially if you were just looking at the crossover, and then once again an entry through here at cross, so you would have entered maybe somewhere through there, and depending on how you manage the trades. Once again, when you do look back and you view the choppy periods there, it's pretty ugly. You're getting chopped in and chopped out quite considerably. So it is worth noting that markets tend to trend maybe 20 to 30% of the time, and so 20 to 30% of the time you might be able to ride a nice trend, but you've got to be prepared to have a high loss percentage. So you'll be getting chopped in and out maybe 70 to 80% of the time if you're using a simple moving average crossover. Now, the last moving average crossover I want to talk about is an Australian-based trader, Daryl Guppy. It's called the Guppy Multiple Moving Average Strategy. It's pretty impressive when you view it, actually, the Guppy MMA. So Daryl Guppy had two bands. He had the short-term suite of moving averages, which are a 3, 5, 8. For those trading Fibonacci's, you'll be familiar with those numbers, and then a 10, 12, and 15. So Daryl preferred to use the exponential moving averages, once again placing more emphasis on the most recent information, and you'll notice that they're consistent across all of these moving averages. Now the second set are the longer term moving averages, and they're 30, 35, 40, 45, 50 and 60 period exponential moving averages. So there's a number of ways to use this particular tool, and Daryl is quite a prolific writer. I think he's written like 14 books. He's appeared on all sorts of TV stations, but he's got a whole strategy around this, and he's also built indicators into your MT4 platforms and Metastock and some of the most prominent trading platforms around. So I would need you to have a look into it, but basically it's pretty interesting to see what patterns you come up with, and when you start to notice the bands are expanding and the volatility is increasing during that time, and when they're contracting, we're likely to see a move, a break out of that section there. So it's really interesting how they're applied. There's a number of different ways you can actually apply it, which makes things pretty interesting there. So well worth having a look at. Have a look online to see how you can look and apply if this looks like something you would like to apply. Actually, I'll just show one other one. I wasn't going to show this, but there is a strategy which I learnt about from an options trader. Now, it does look pretty complicated, but basically there's a 2-period moving average, which if you remove the share price, the candles, the 2-period is supposed to represent the closing price, sort of like a line chart. Then you've got you'll see these ones here are 15-period, and it's a 15-period moving average on the low and a 15-period moving average on the high, and then you've got the longer sort of medium term 10-period simple moving average there, just as the dominant trend. So basically, as you're applying these particular indicators, you're starting to look for patterns and where the breakouts are occurring and how you might be able to apply it to your trading strategy, and more particularly across your time frame. So there's 6 moving average strategies that you can apply to your Forex charts. Obviously, do as much testing as you can. I cannot suggest that any of these actually work, but moving average strategies do tend to work in trending markets, and they're very, very choppy, and they'll cost you brokerage in and out and so on, or slippage and so on. When markets are tracking sideways, when they're range bound, it's very, very difficult. Also, you might want to consider making sure you have a trend direction filter. Maybe have that 100-period moving average where you're looking back, or making sure the price is above that. So there's a couple of ways and tools that you can use there. Hopefully you can apply them. Maybe you're already applying them, but if not, hopefully that gives you some food for thought and some different ways that you can actually apply different moving average strategies. So all the best. Hopefully if you like this, please give it a thumbs up and subscribe to the channel, and of course all the best with your trading. Thank you.